All right, I think we're in. Okay, so can you see my screen? Can you
Yes,
guys?
Sir.
yes.
Okay, good. All right, so let me show you some things real quick. This is GPP, GPY, and this is 4 hours. And before I proceed, guys, there's things you guys need to understand. Like you know before now, trading is not 100%. Okay, the the only thing that you need actually is that your profit should be better, should be greater than your losses. Okay, anyone, even the experts, the founder of this strategy, even make mistake. Okay, well, we all, we are human beings, we make mistake. That's why I want to teach you guys this thing so that uh we can, we can give setups together, so that in order to maximize profit. All right, so first thing first, what I wanted to tell you guys is there's what is called institutional order flow. Okay, can you guys still hear me?
Yes, sir.
Okay, there's
Yes, sir.
what, okay, there's what is called institutional order flow. And when we say institutional order flow, we are talking about the consistent movement of market structure. Can you still see my screen?
Yes, sir.
Yeah.
Okay. Now, institutional order flow is the consistent movement of the market, either to the upside or to the downside. In retail trading, that's what is called trend. Okay, but there are some things that retail traders call trend that are not actually trend again. And remember, we're not trading based on retail, based on retail trading, but we're trading based on institution. That's, we're trading alongside with the banks. So we're only buying when the banks are buying, and we are selling when the banks are selling. Now, there's what is called institutional order flow. Now, what it means is that is the consistent movement of order blocks or source from the, either from the downtrend or from the upper trend. All right, bullish, bearish, or bullish. So that's what's called institutional order flow. And understand this. Based on ICT, a trend is still valid until there is a break of market structure. Let me explain what I mean. Now, you will agree with me that the market move in a series of higher highs, higher low, higher highs, higher low, higher low, higher highs, and higher lows. Right? You can agree with me. This is how the market moves. Now,
Yes, sir.
this is called, we can say this is an institutional flow. So let's say this movement, is working in the 4 hours or the daily time frame. And another thing you must understand is that the market respects higher time frame than the lower time frames. And every time frame has its own structure. You can find these structures in any time frame. All right, but the higher time frame actually controls more of the lower time frame. So we can put together that this market is an uptrend. Why? Because there's a consistent creation of higher highs, higher lows, higher highs, higher lows, higher highs, and higher lows. Then if it's a bearish market, if it's a bearish market, there will be a consistent move of the market, right? From higher low, lower high, lower low, lower high, lower low, and lower high. Okay, this is it. This is the structures. Now, for you to be on the safer side, actually, you should know the institutional bias. When I say bias, I mean the institutional flow. This is what I mean. You must know the institutional bias. You need to understand the institutional bias if you must be on the safer side whenever you are trading. It's not as though the market cannot move against it. It can, but it is safer. All right, so we can rightly deduce that this market is currently an uptrend, while this one is a downtrend. It's a consistent move to the downside until there is a break in market structure. And how do you know that there's a break in market structure? Now, when there is a failed swing, for instance, this market has been creating higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and say it fails to create a high here, that's a failed swing already. Now, mind you, once it's equal like this, it's still an uptrend. It's still an uptrend. But this thing is telling you something. It's trying to tell you that the momentum to the upside is getting weaker, right? So let's say it created an equal high and it came back to this level. Say it came back to this level. This is still an uptrend. Why? One of the reasons why this is still considered an uptrend is this high did not surpass this one, and this low did not surpass this one, which makes it that the other flow has not been broken yet, which means we are still bullish in the market. So how do we know that the market is broken? When you see something like this. When you see something like this. Can you see this? Can you guys still see this?
Yes, we can.
Yes, sir.
Okay. Now, this simply means that the market has been broken. The market has been broken. The market broke from this area here. Even if it is 1 pip, especially if it has to do with the higher time frame. There's break in market structure, so we can easily say this is break in market structure. Based on what I sent you the other time, what is break in market structure? Can somebody tell me? Hello? When we say break in market structure, the abbreviation for it, can somebody tell me?
Yes, sir.
Is what? I can't hear you.
BMS.
Okay, correct. BMS. That's
BMS.
Yes, I said correct. So we can say this is a BMS. This is a break in market structure. Meaning this is trying to tell us that the market is about to go to the downside. It means that the bullish traders have lost, they are losing momentum, and market is now going to the downside. And that's when you begin to see the market will begin to create this. Can you see this? So that's where you see that the market begins
Yes,
to
sir.
create a higher low, lower low, lower high, lower low, lower high, lower low, right? So this market can only be taken out again if there is a break in market structure. If there is a break in market structure, this market can now begin to move to the upside. Now, this is a continuous movement of market to the downside. So we can say this is a bearish market. So to be on the safer side, it's better you take only trades. You take trades that are based on this, trades that give you selling opportunity until there is a break in market structure like this. Until there is a break in market structure like this. Now, there's a low here, right? Now, this high is greater than this one. Then we can easily say that this is a break in market structure. We can say this is a BMS. Can you see that now? You can say this is a BMS. And there's what is called the breaker. Now, this is the breaker candle, not this one. This is the breaker candle. This is the breaker candle. Right? So this is the breaker. This one, this candle here is the breaker. So you will see that price will always move above it. And for you to enter safely, it's better that you wait for price to rally up. Now that you know the order flow, institutional order flow, it is safer for you to allow price to move above it and come back to retest the order block. Now, based on what I don't know if I can get those things I sent you the other time. I sent you some stuff that based on what will be, say, most of the patterns we are going to be trading with, right? I sent you, but I don't know if I can get it now. Now, there you are going to see that in one of the patterns, you can take trade here at this level. You can take trade at this level. You can take trade at this level, and you can as well take trade at this level. You see that? So let's go to the live charts. Let's go to the live charts. Okay, so this is a live chart, and as earlier stated, remember this is the 4-hour. This is the 4-hour time frame, and the market has been creating say higher high and higher low, equal high, and this one did not. Remember what I drew? This is it. Look at it. Remember I drew this before I drew this before now. Higher highs, higher low, higher highs, higher low, equal highs. You see that? And higher low. This low did not overshadow this low. So we are still in a higher trend. And if you notice, there was an institutional candle. This candle being placed here purposefully by institution in order to take our stop loss out of the market. Now look at it, another high, and look at it, a low was formed there. Now this low, you see that? we can say this is the BMS, break in market structure. Okay, break in market structure. And this is the breaker. This is the breaker candle. The breaker candle. You see? So now this was the candle that was broken, and we can actually wait for price to come to the downside, but in this case it did not come to the downside. Okay, you can actually wait for price to come to the downside and retrace back to it, then we sell, or we wait for it to get to this other block. Look at this, get to this other block, then we sell. Remember, this is a higher time frame. If we are to take this to say 15 minutes chart, remember, always enter in the lower time frame. Where is it? Let's see if I can find it. Okay. All right. Always remember to enter trades in lower time frame, because by so doing you are going to be on the safer side. I don't know why I can't find it. Okay, let me use this for an example. Now look at this. The market rallied up, and there was a breaker candle here. There was a breaker here. Even if it's a week, there was actually a breaker there. Here, meaning this thing is telling us that the market is about to change shape. It's about to move to the downside. Okay, and if we want to use this as a breaker, is very much possible. Okay, but I think it will be better if this is in the higher time frame. Now you see how price dropped after there was a breaker, after this candle broke, but it did not come down at once. It went up first. It went up first, so at least it's supposed to get to this point before it finally falls. But the market is not always like that. I believe that was one of the reasons we lost one of the trades. I think it was yesterday. Now that's that. Okay, for instance, let's look at this. Let's look at this one. Let's look at this one. Remember, this is a 15 minutes time frame. The market, there's a consistent movement of the market from up to the downside. Up to the downside. There's what is called the last step broken. Okay, so this was actually the last step broken here. Now this area looks like accumulation. You see that? In areas like this, it's advisable that we don't actually trade. Now what you are seeing here, you are seeing this purposefully. The banks and the institutional traders, they are the ones doing this in order to induce us to enter trade, so that they will be able to eat our stop loss. That's what they do. And believe me guys, in most cases we actually fall into this kind of trap. In most cases, okay, we actually fall into this kind of trap. And you see the following candle, the candles that followed it, how big these candles were. You see that? After hitting our stop loss, they'll begin to run. Now that's what we call eat and run. That's what we call eat and run. Now look at this. the market broke structure, meaning that the market is about to go to the upside. And if you notice, there was a good high right here. All these are liquidity, right? That's why I said with time, okay, you guys are going to understand this. All right, probably I'm going to send you a course. All right, I'm going to send you a course by the founder of this strategy. Okay, I believe it's going to help a lot. So you guys, you are going to watch it step by step from month to month. Is a full-fledged course from January to December, but you don't have to wait for January to December to finish it. So you just watch the videos from January till say from the first month 1 to month 6. You should be good. All right, there are some things you need to understand here. Now, this was the last step broken. Actually, it should have been wise for us to wait for price to get to this level, to take trade, or wait for this other block to take trade. All right, so but if you really know what you are doing, you see, we would have missed the trade if we would have missed this big move if we were waiting for this. But actually, that's the safest zone. There's what is called premium and discount, sell or buy. All right, you cannot learn everything in one training. Okay, there's what is called discount and premium. All right, now discount is you buying at a cheaper rate. All right, so for instance, this would be a discount. The discount is the lowest point. Okay, say let's assume this is what you want to work on. The discount is gonna be the 50% level. The 50% level. All right, that's the discount. That's the discount. So anything, if you buy below this 50% level, it means that you'll be on the safer side. All right, that's what it means. Why above it's premium, you are going to buy in premium. So let's assume you took the trade here, you would have enjoyed this good move. Right now, look at this. Like I said, it's not always like that. Okay, it's very, very vital. So it's better that you get trade from the lower time frame, then before you proceed to you get the trade from the higher time frame before you go to the lower time frame for entry. That's the best part. So do you guys understand what I mean by order flow? So when I mean institutional order flow, you should be able to understand what I mean, right? Are we good?
Yes, sir.
Okay.
Yes, sir.
Yes, sir.
We are getting.
Okay. All right. So all these large candles you are seeing here, these are candles that are purposefully placed there by the banks to steal our stop loss. All these wicks are being placed there so that our stop loss will be stolen. But thank God for Michael, who have taught us the strategy so that we will not be among those people whose stop loss will be hit. Now look at this. The market always move up and down, and the banks always create what is called liquidity. The banks are fond of creating what is called liquidity. All right, now this is when the banks or the institutions create should I call it a platform? That's they are putting these things there purposefully so that retail traders will be stopped out, because it is when we lose money, that's when they make money, and they are the market movers. That's why they are called the market makers. Okay, now whenever you see equal highs, you need to be very careful. Remember, you are told by retail traders, we're always told by retail traders guru, that whenever you see double top, you sell. Whenever you see double bottom, you buy. Maybe most of you before now, that's what you have been doing. But the truth is that these double tops and double bottom are being placed there by the institutions in order to take us out of the markets. In order for them to take us out of the market. Now, let's assume that we are trading based on equal highs or based on support and resistance. Now, you agree with me that this could be termed as a strong resistance based on retail trading. I'm speaking of about this point, right? And we can also say that this is a very strong support, because as at then we wouldn't have known, we wouldn't have seen this area, right? Now look at what the banks do. In the first run, they might give it to the trader, which we saw here. But for those guys, once this meeting closes, I want you guys to re-enter. All right, in less than 10 minutes it should. So I want you guys to re-enter the meeting. Okay, so now what they do is, so what they do now is this: they are hunting the stops of retail traders, and that's what we call stop hunt in ICT. Stop hunt. That's what we call stop hunt. Okay, because they are hunting our stops. That's why whenever you are in the trade, suddenly you will see a very large candle or a quick wick, just like this one, and the next candle you see that is going to be very big. It's going to move up very fast, because they don't want us to eat on the market. And these are what we call turtle soup. I've spoken this to you. I've told you this before now in our previous meetings, in those free classes. This is what is called turtle soup. Okay, now if you notice, remember, this is all this move. This is a great move. This is a great move because this is a 4-hour chart. If you take this to a longer time frame, you are going to see that this is going to be a very big move, a very big one. Now let's see some. So guys, so far, do you have any question? You feel free, ask me your questions now based on what I just taught you now.
I don't know if Godwin has I don't know his name, Goddy. Sorry, I don't know if you have a question. But for me, sir, if you can give us a clear definition of that turtle soup.
Okay. Now, the turtle soup is now, let's say this is it. In most cases, for you to actually see a turtle soup, you must first of all see an equal low or equal high, because those are manipulations. You can see something like this. Equal lows. And suddenly you are going to see this. Boom. You know why? Because most traders are going to enter the market here. Most traders, or probably the ones that miss the trade, who who could not get in here wait for the next support to be hit. Now, support and resistance traders, they are going to take their buy from this point here. From this point here. And if you notice, immediately they enter the trade, there was a push to the downside, as you can see right here. Immediately they enter the trade here, there was a strong push to the downside. And this is what we call a turtle soup. And in this case, this is a turtle soup buy model. A turtle soup buy model. This is the turtle soup. This is the turtle soup.
Excuse me, sir.
Okay.
Sir.
Go ahead, please.
Please, can you write it down? Network is not really the best. I can't hear the pronunciation very well.
That's it, turtle soup. That's what it's called in ICT. So in most cases,
okay,
guys, whenever you see this turtle soup, then get ready for a buy. In most cases, it may not be in all cases, but in most cases, you should get ready for a buy. Why? Because the stop arms has been placed successfully, meaning what the banks were looking for, they have gotten it. So now they are now starting to accumulate orders for buy. All right, to aim for the other liquidity. Now all of this is what we call liquidity. I've said that before. This is what we call liquidity actually. Okay, so they actually look for liquidity, and this is also what we call buy stop. Buy stop or buy. Yeah, this is what we call buy stop or BS or BST. This is what we call buy stop, this area, and this is what we call sell stop, because the banks actually, they'll be looking to take profit at this area. Okay, they'll be looking to take profit at this area to make sure that they clear off every liquidity that is here, every liquidity that is here. Okay, and all of this stuff combine this area, this equal wicks you are seeing, this equal wicks you are seeing, this can also be called liquidity pool. This can be called what? Liquidity pool. Okay, this can be called liquidity pool, this area. All right, so these are some of the things you guys need to understand. So please, I want you guys to rejoin this meeting. I'm going to end this meeting now, then rejoin immediately. Is that okay by you now?
All right, sir. Yes, sir.
Okay, so
It's okay, sir.
I'm ending this meeting now, so you guys should rejoin.